ultimately, every time the dollar gets too strong, the Treasury market is going to dysfunction. It is a mathematical certainty. Based on what I know, that is absolutely the wrong price.
What is a logical move in response to what should be happening in Iran?
Let's not forget, where are we putting our data centers because we don't have the infrastructure here as it relates to the NASDAQ?
Yeah.
UAE, Saudi. Think about that.
20% of the world's oil flows through the Strait of Hormuz, and with that closed now, where do the nations around the world that rely on oil imports get their energy next? What happens to our economy once oil hits $100, if it gets to that? What assets are next to move, and what happens when we get massive inflation if that were to be the case? Joining us to discuss these topics and answer these questions and more on how to survive the current volatility is Luke Gromen, founder of Forest for the Trees. This video is sponsored by Kalshi. It's a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Sign up and use my code LIN. Link in the description down below, or scan the QR code here. New users will get $10 deposited to your account when you trade $10. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. Luke, welcome back to the show. Good to see you again.
Great seeing you too, David. Thanks for having me back on.
You've been tweeting a lot about the Iran conflict. I'll just show one on the screen. Brent crude prices versus U.S. 10-year Treasury yields since January 1st, 2025. And the two have moved almost in lockstep, except now there's a bit of a divergence. And I wonder if you could comment on what this divergence means and whether we should be, I guess, either long bonds or short oil, if it's how I'm interpreting this chart.
You know, for me, I think you should be short bonds. I think you should be short duration, particularly if this conflict goes longer, which my confidence that it is going to go longer than expected rises by the day, certainly relative to expectations or relative to what appears to be investor consensus at the moment. Look, the world holds treasuries, and the world needs oil and food. And one is on some level being disrupted. And so, is the world going to hold its treasuries and starve itself of food and oil? Or is it going to sell its treasuries to bid up oil and food? And to me, it's not a very difficult question to answer. And so, ultimately, the longer this goes on, I think you will see a huge natural buyer of treasuries turn seller, which is to say the entirety of the not just the oil importing creditors of the United States, which would be China, Japan, Korea, Europe, but arguably also the oil exporting creditors of the United States, because they can have treasuries or they can have weapons, but they can't have both, unless the Fed prints the difference, in which case I don't want to hold bonds either.
Would you be long U.S. Oil producers right now, ExxonMobil being one of them, for example, as China, Japan, Korea, Thailand, all these countries in Asia rely heavily on oil coming out of the Strait of Hormuz, which is now closed? I believe something like 70% of the oil coming out of the Strait of Hormuz needs to go to Asia. And as you've seen earlier this week, Korean stock markets, Japanese and Chinese stock markets alike have all fallen as oil prices have risen. So where are they going to get their oil from now?
Short answer is yeah. I would be long oil. I think that is good, all else equal, for U.S. domestic oil majors. I think they'll get their oil from wherever they need it from. Oil is very, very inelastic, and in terms of its demand. And so where will they get it? Wherever they can. And if that requires selling, so far they're selling Korean stocks in Korea, right, to get liquid. It won't be long till they start selling treasury bonds, till they sell, other assets. Ultimately, you got to have oil. You don't have to have other assets.
Luke, have you repositioned your portfolio or your allocation or your recommendations since the start of the Iran strike last Friday night?
Only added gold in my own personal investments. I came into this year, we've told clients my portfolio coming into this year was more than 50% of my liquid net worth was in cash, T-bills, and gold miners. I didn't forecast a war in Iran. I didn't think we would be that foolish, to be honest. But I saw a number of other things where there were problems, potential problems that made me uncomfortable enough to have a very risk-off position. So better lucky than good for now. The only change I've made is I've added to that already very heavy gold position.
Even at, what are we at now, $5,100, $5,200, it's not overvalued for you, Luke?
Not even close.
Why is that? Just the macro backdrop for gold, Iran war aside, what drives it higher?
I look at it and say, gosh, there's so many factors that drive it higher. The valuation, it is still the cheapest asset on the board. So if you look at U.S. foreign held debt as a percentage of the official U.S. gold holdings at market price, in other words, what percentage of the foreign held treasury bonds outstanding are collateralized by gold at market price, by U.S. official gold at market price. 1989, that was 20%. 1980, it was 135%. The long-term average is 40 to 60% today. Even with this massive rally, it's at 13, 14%. So gold would have to rally enormously, 50, 60%, just to get back to the 1989 levels of gold's price where U.S. official gold would collateralize foreign held debt. When we then layer in levels of global sovereign debt and stress, particularly what I'm seeing out of Japan, where we are seeing emerging market price action in the JGB market, where in the second half of last year, we started to have this very unusual setup of Japanese 10-year government bond spreads over U.S. 10-year, so U.S. 10-year minus 10-year JGBs, and then chart that on a second axis against dollar yen. Normally, you would expect rising JGB yields relative to treasuries to drive a stronger yen, not a weaker yen, yet it's driving a weaker yen. That is emerging market price action in the second biggest bond market in the world and a very important economy. I don't know how that works out, but I know it's not good for risk either way. And more importantly, it's really good for gold either way. Then I look at the geopolitics more recently. You know, everything the United States has done over the last 5, 6 years is telling you that treasury bonds are not safe for foreigners. And they're in what they've just done in the last week, which is kill, regardless of how we may feel about Khomeini, let's set that aside. He was the sitting leader of a major world country. And we just assassinated him. And that's okay. That's what we did. It is what it is. I'm not judging. However, are foreigners really going to put their money in treasuries? Are they really going to put their money in stablecoins that the United States can just burn up at will? No. The reaction to this is going to be a further acceleration away from treasuries into gold as a reserve asset, which is already happening anyway, and which on some level is actually in U.S. interests to reshore. When I look at the fundamentals right now, in 2025, the second biggest export of the United States was non-monetary gold. Out of everything else the United States makes, the only thing that was bigger were pharmaceutical preparations. We were shipping it to Switzerland. Where was Switzerland shipping it? China, Hong Kong, UAE. So America is essentially net settling part of its trade deficit in gold. That's just a fact of the trade flows. U.S. is running very big trade deficits, even with a much weaker dollar. I think that's supportive of gold. So I think there's a lot of different things. The valuation's cheap, the geopolitics are supportive, the sovereign debt situation is supportive, the trade flows are supportive. So yeah, I still, I think gold's probably got to at least double, if not triple, before it actually starts to, get to a point where I would start thinking about letting some of it go.
Okay, well, let's talk about the dollar, and we'll come back to your gold forecast towards the end and how that's going to impact the rest of your portfolio. The dollar has interestingly risen since the beginning of the year, beginning of February. It's come down a little bit from its top just a couple of days ago, just yesterday, actually, Luke. And the question I have for you is how demand for the dollar and treasuries will change specifically as a result of the strike on Iran and the closure of the Strait of Hormuz. One way to look at it is, yes, you're right. There's going to be de-dollarization happening for the reasons you stated, but perhaps countries may now be forced to buy U.S. oil because of the closure of the Strait of Hormuz, which ironically works in the U.S.'s favor. Which way, which way do you see this playing out?
They might need to buy it. I I think all else equal, more U.S. exports is good for the dollar, right? You are exporting oil instead of exporting dollars. You're soaking up global dollar liquidity with oil, essentially. Dollar out, oil out, dollars in. Um, so that is very possible. The challenge here is the challenge that has continued to exist this whole time, that this administration, the administration before want to pretend like it doesn't exist. But ultimately, every time the dollar gets too strong, the treasury market is going to dysfunction. It is a mathematical certainty. Every time the dollar gets too strong, U.S. equities are going to sell off. It is a mathematical uh, double entry bookkeeping identity. It's a certainty. And the reason I say that is foreigners have borrowed 13, 14 trillion dollars in US dollars, right? So they're short 13, 14 trillion US dollars. Uh, but they also own $70 trillion gross, $27 trillion net of US dollar assets. The United States has a negative international investment position, or NIIP, of negative 95% of GDP. Maybe it's negative 90%. And so anytime the dollar gets too strong, foreigners are going to get squeezed on their dollar borrowings. And when they get squeezed on their dollar borrowings, we can go back to what we talked about earlier. Our foreigners are going to sit there and go, oh no, we're getting squeezed. What do we do? No, they're going to sell what they can, not what they want to. They're going to sell what they can. What's the first thing they can sell? They own $9.5 trillion in treasury bonds, push them out the door. And so when you look at dollar against 10-year treasury yields over the last 5, 6 years, very positively correlated. And so all else equal, yeah, more oil exports would in theory support the dollar, help the dollar. Risk off helps the dollar, but strong dollar doesn't help U.S. risk assets. It doesn't help treasury markets, especially since the U.S. economy essentially is the S&P 500. When you look at U.S. tax receipts going back 10, 15 years, as we have, just net capital gains plus taxable IRA distributions alone is over 200% of the annual growth in U.S. consumer spending. So U.S. consumer spending mathematically cannot grow if stocks don't rise. And the U.S.'s massive net international investment position, massively negative, makes it mathematically certain that stocks can't rise if the dollar gets too strong. So, for me, it's not a question of, hey, let's weaponize the dollar, or, the question is when does the dollar get too strong, strong enough to break the treasury market, like it did last April? If we remember, right, dollar spiked for a second. Well, last April is probably a bad example. Last April, dollar wasn't even dollar weakness, or it wasn't even dollar strength. But if we go back to 3Q23, 2Q24, 1Q23, 3Q22, dollar gets too strong, treasury market dysfunctions. Treasury yields get to 4.6, 4.8% on the 10-year. We start having a debt spiral. We start having risk-off problems in equities. Everything goes pear-shaped. So to me, the dollar is absolutely a key linchpin. It can't be allowed to go too high, or at least high enough until it starts creating problems for treasuries. So, I understand why the dollar rallied the way it did. I understand. But it's a self-limiting rally.
You know what's a really good economic contraction indicator, since we're talking about both gold and oil, is the gold to oil ratio. Peaked in 1970, 73, followed by gray bars, Ember designated recession. Peaked in 1980, followed by a recession. 2008, followed by a recession. Interestingly, didn't really peak in the dot-com bubble, but anyway, there was a spike there, followed by a recession. No recession now, and no talk of a recession in the media, at least for now. But last time this happened was 2020. Now, oil, let's see what happens to oil. Let's see what happens to this ratio. But how are you reading this chart?
I read that chart a little differently, which is I go back to that chart. To me, the gold to oil ratio is a measure of the health of the petrodollar system.
Okay.
Which is to say, the higher the gold to oil ratio, the sicker the petrodollar system is, the worse shape it is. The reason for that is that gold competes with treasuries as primary reserve asset. And so higher gold prices, all else equal, will compete more effectively with treasuries. The higher gold price get, the more money can go into gold as a reserve asset, and the less confidence there is in the dollar. Similarly, the lower oil prices are relative to gold, the less dollar. So right up until just recently, a few years ago, oil was only priced in dollars. And so the lower the oil price gets, the lower the dollar surpluses that are generated, the petrodollar surpluses that are generated and recycled back into U.S. financial markets. And so a high gold to oil ratio is a sickly petrodollar system. A low gold to oil ratio is a healthy petrodollar system. And that's what this chart shows. When you look at it, 73, it was pretty sickly. 85, it was pretty healthy, or it was strained a bit, I should say. There were some deals done there, right? We devalued the dollar significantly in 87, and bought time for that system. 2000, 99 to 2000, 2001, that was a very healthy time for the petrodollar system. Russia was very sickly. They were dumping oil, but gold was very cheap. You know, who needs gold? We have Greenspan. I look at this chart from 2007 on, and I think 2007 is when things really changed. That's Putin's famous Munich speech, where he came out and said, listen, this isn't working for us. And ever since then, oil has gone for the gold to oil ratio since Putin's, I think it was April 2007 Munich speech, has gone from roughly 6 or 7 barrels of oil per ounce to nearly 80. And what did Putin do after that speech? Shortly thereafter, he started buying gold. And then in 2013, 14, he stopped buying treasuries and bought more gold. And then in 2014, he and China agreed to start transacting energy outside the dollar and net settle it in gold. And the reality is the oil market, in 2014, the oil market was 20 times the size of the gold market, 15 times. Now it's down to, I don't know, 6, 8, 10 times bigger, just oil, not gas, not copper, not. And so what I think that chart is telling me is that the world has gone multipolar, and that we are now seeing marginal oil and energy and commodity deficits being settled in gold at the central bank level. Because if you look really after 2022, it was up to 20, 22, 23 on the gold to oil ratio. Since then, it's quadrupled, tripled or quadrupled after the United States froze Russia's FX reserves in response to the invasion of Ukraine. That was a declaration that treasuries are no longer safe for foreigners to hold as a reserve asset. I would argue that it was very good for the United States in the long run, but it was bad for treasuries in the short run, and it was very, very good for the gold to oil ratio. So that's how I look at that chart.
But isn't the Iran regime change actually a stabilizing factor for the Middle East and perhaps globally, which may put downward pressure on the demand for gold as a safe haven asset, as a hedge to geopolitical risk? Can you comment on your thoughts there?
That's the $64,000 question, I would say. You know, was removing Saddam a stabilizer to the Middle East? Was removing Gaddafi a stabilizer to the Middle East? The hubris of Anglo-American foreign policy is, I don't know. The one it reminds me of, I don't know if the movie Billy Madison from Adam Sandler, right? Where the old man keeps falling for the flaming bag of poo trick. The kids light the bag of dog poo and put it on his porch, and then he steps on it and gets poo all over his shoe. It's like American foreign policy in the Middle East since my younger days. I mean, my goodness, we've been at this 25 years. What have we done? Well, we lit the Mideast on fire. We ran up. I don't know. When we went into the Middle East, I think we had 6 trillion in debt. Now we've got what, 38 trillion. The highest inflation print when we went into the Middle East in 2001. In the prior 20 years, I believe, was like, or prior 10 years, excuse me, was like 3%, 2%, 3%, 4%. Highest CPI print since we've been there has been over 9%. The current account deficit, or the fiscal deficit of the United States, 3% when we went in. Now it's what, 6, 7%. So, and oh, by the way, how is our position vis-a-vis China? Was it strengthened or weakened by us going to the Middle East and getting distracted? Uh, China was nowhere 25 years ago. Now we're worried about China. So I think, look, yes, if this thing goes swimmingly and it goes all awesome and we're able to install basically a Boris Yeltsin in Iran with very little disruption over the next couple of months at most, and they get right to selling oil to America in dollars and cutting off the Chinese and selling off other parts of their mineral wealth to Western investors like Yeltsin did for pennies on the dollar, then yeah, sure, this is going to be unbelievable for America.
How long
Failing
does
that,
China? Yeah, please. Sorry.
yeah, no, I was going to say, failing that, I think this Iran situation is so bullish for gold. It's like, I mean, I don't think people. Like I said, it's the one thing I've added to this week. And again, I'm not like a day-to-day
Right.
trader, but to me, it's just so obvious. When I saw gold get whacked this week, I said
Mhm.
that's the wrong reaction. 100% that's a wrong reaction.
What is the correct reaction or foreseeable reaction from China then, given that China has been so far quite muted on the international stage in its response to the Iran strikes? They've condemned it publicly, but beyond that, not much action. I was expecting at least more export controls on critical minerals as retaliation. I don't think I've seen that in the headlines yet. Is that a reasonable response to expect in the foreseeable future in the next coming weeks, Luke?
Yeah, I think it is, and I think the Chinese will do it in a very Chinese way. I really hope at some point, look, I love America, and I don't know how many times our administrations, both sides, need to bang their heads against the wall before they start realizing they don't really understand China. Um, which is to say, I think the Chinese are going to respond as the Chinese do, which is they're going to condemn it. They're going to say everybody should come to the table and talk, and they're going to be very passive aggressive, and they're not going to do anything boisterous or forceful or react like an American or react like a Brit or react like a German or even like a Russian. They're going to say nothing. And in about 2, 3, 4 weeks, President Trump is going to get on social media and start complaining about how none of the rare earths are flowing and that we're suffering shortages. And Bessent's going to go on the Sunday morning talk shows, or Vance or Hegseth. They probably won't send Hegseth. They'll send one of those three. And they'll say, hey, China's not abiding by their side of the deal. We are running into severe constraints, blah, 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 blah. And then you'll know. And that's how China will react. Or China will do something like take high definition photos of the American bases that have already been destroyed in the Middle East. And in another couple days, after the Americans get out there and say, hey, it's going great, it's going great, it's going great, and the Chinese will release a photo showing a completely destroyed American base. And with the coordinates, anyone can call them up. Hey, because there's private satellites, it'll take the same picture and discredit the American administration that way. That's how they'll do it. And that's probably what's going to happen. And then that will raise questions. The reporters will ask Hegseth or Trump, hey, you said it's going great. Why is that base a smoking crater over there in, UAE or in Qatar or at Bahrain? And, Trump will say it's, whatever. He'll wave his hands and he'll say whatever he's going to say. The Chinese are not going to sort of stand up and sort of punch back. They are going to react in a very Chinese way, like they have for 30 years. I mean, how many times do they have to react this way till Western policymakers actually start thinking more along how they're going to react?
Have current events changed the way you look at defense stocks, Luke?
Not necessarily. I mean, I think, look, it's been good for them. Very clearly, we're going to spend more money there. I was just seeing someone flag to me earlier. I think they're asking for another $200 billion, the U.S. government, to spend on defense, which is it's good for those stocks. It's, if you're bullish on the deficit, it's very good for the deficit. It'll push us back over two trillion probably pretty easily. Um, it's not great for long-term treasury bonds, certainly not on a real basis. But yeah, I think ultimately, we have real constraints, and they are. Trump called the heads in, I guess, of the defense companies yesterday. And said, hey, you need to move faster. Well, that's great, but they can't move any faster than China lets them. And that might be how China responds. Trump calls them in, yells and screams at them, hey, we're running short of interceptor missiles, and they call up China, and China's like, oh, the dog ate my homework. Sorry. Don't know where they are.
Why do you think U.S. equities markets are basically not pricing in any risk of escalation right now? And if I mean, if the conflict in Iran escalates to beyond regional containment, we should be having a massive sell-off. And in fact, quite the reverse is happening right now. The Nasdaq is up almost 2% on the day on Wednesday.
Sold to you. Based on what I'm hearing, sold to you. uh, Look, you're seeing force majeures in various commodity markets in the Middle East. You are seeing Asian stock markets, Korea in particular, tank.
Yeah.
Now it's spiked up, but it's tanking off of that spike. You are seeing Western different multinational companies pulling people out.
Yeah.
When you get oil majors pulling people out, you really think they're not talking to the Defense Department? You've got Hegseth admitting we're not going to be able to defend against drones. So that is, up 2% today. Like, who knows? But that's the wrong price. Based on what I know, that is absolutely the wrong price.
What is the correct move in your opinion? What is a logical move in response to what should be happening in Iran, or what's going to happen next?
Lower, quite a bit lower.
Well, you know what's interesting? I'm just going to pull up this chart. The VIX has been steadily rising since the beginning of the year. I mean, ups and downs every day, but the trend has been higher. Huge uptake on the day of the strike, and then now it's come down a bit, but it's been trending higher since beginning of the year. Is this a reflection of anything, or has it just been, has volatility just been oversold? What do you think?
Yeah, I think it was probably from an oversold position, but even where are we trading today? Is that say 20? Like, yeah, that's a joke.
Yeah.
Based on what I know, whether I look at that, whether I look at credit spreads, I know we wrote this last week and the week before, and it was around other factors, but whether you look at VIX, whether you look at credit spreads, whether you look at the move Treasury volatility index, whether you look at, things like XLY over XLP, right? The consumer discretionaries over the staples. It is just complacency across the board from investors. And, I would just say, what do you want to own if we're at war with Iraq in 3 months? Or, excuse me, with Iran in 3 months? And the deficit isn't $1.7 trillion, it's 2.6 trillion. And what and there's no obvious end in sight. What do you want to own? Is it NASDAQ? Maybe Palantir within NASDAQ, and but and oh, by the way, let's not forget, where are we putting our data centers because we don't have the infrastructure here as it relates to the NASDAQ?
Yeah.
UAE, Saudi. Think about that. We can't defend against drones, and you've got major Mag 7 infrastructure sitting in places we can't defend against drones. That's not me saying that. That's Secretary Hegseth, who is as cheerful and as optimistic a view as you're going to get on what's happening there right now is coming from him. And he's telling you we can't defend against drones.
I'm just going to posit a theory here. So perhaps the S&P 500 being so heavily weighted with tech companies right now, which, as we know, their primary costs aren't oil. It's not a resource heavy physical kind of company. A lot of their software and even hardware doesn't rely on oil for margins. And so perhaps we're looking at a stock market that is immune up to a certain point, of course, to higher oil prices that would immediately impact their margins. Of course, we know higher oil prices down the line would impact consumers negatively, which may impact negatively discretionary spending, which may hurt some tech spending. But we are so far witnessing no downturn in the NASDAQ. So maybe this time is really different. What do you think?
I mean, it's possible. It's possible. End of the day.
Yeah.
If rates are going to go up, so look, if real rates are going to go up as a result of either high forced selling of sovereign bonds to by the world, basically to buy oil. Um, I have a hard time seeing a world where rising real rates are positive uh, for stocks, and particularly for the interest rate sensitive Nasdaq. Now, if you tell me, well, Luke, they're already discussing behind the scenes that they will cap yields, then that makes sense. Then yeah, then I say, hey, buy Nasdaq, short dollar, and bond yields probably stay where they are. And if that was happening behind the scenes, right? If Besant was in there with the Exchange Stabilization Fund or the Plunge Protection Team, whatever you want to call it, and he was selling dollars and he was capping yields, what would I expect to see? I'd expect to see VIX down. I'd expect to see yields relatively stable. I'd expect to see dollar down. I'd expect to see Nasdaq up, and I'd expect to see gold up. So it's really interesting to me. That's exactly what we're seeing. I'd expect to see Bitcoin up too, by the way, right? Up 7% today. That's that's potentially interesting. So, they've got options. Um, it's all just what trade-offs do they want to make?
Where do you see this going? Right now, I'm seeing reports that perhaps Trump wants to arm the Kurds, and that we're going to get basically insurgents now putting boots on the ground to fight this regime change. And if so, we're looking at a prolonged conflict. And so that's one possibility. And Trump says that this could last possibly weeks. He just announced that we're expecting more American casualties, as any war would expect. So he's basically telegraphing that this is not over yet. Where do you see this headed?
He knows it's a lot worse than that. And I mean, this is the same man who said anybody who said we had not already destroyed all of Iran's nuclear weapons was fake news. That was literally the headline of the White House press release on June 25th, 2025. We have completely obliterated Iran's nuclear weapons. Anyone that says otherwise is fake news. That's the headline from the White House. You can find it on. So, what do I think he
Do American troops get put in Iran? Is
I
this
don't know.
Iraq 2.0?
I hope not, because I think that's why he's talking about the Kurds, right? I mean, you can find this online. Russian, anti-Soviet freedom fighter leads his army to peace.
Yeah.
This is the old Osama bin Laden, right? Giving weapons to rebels has not worked out well in the long run for the U.S., I would argue, but that's neither here nor there. Will he do that with the Kurds? I don't know. That's out of my bailiwick. I could certainly see that happening. Is that going to be stable? My understanding is the Kurds can't agree with each other, let alone, right? So now we're going to arm them. It's destabilizing.
Beyond gold, what does an investor do to protect against volatility, or more broadly, invest in an era of uncertainty, with uncertainty being the main theme? What is the uncertainty play?
To me, the uncertainty plays are you want to go to, right, certainty. Obviously, setting aside gold. Look, I think you want to have an far above normal allocation to cash and T-bills. And I think then from a fundamental standpoint, I think you want to own things where you get a pretty strong sense, A, that the fundamentals are going to be solid, and B, the valuations aren't that stretch. For me, I still have a very large position in electrical infrastructure equities. One way or another, we're going to be spending a lot on our grid. War doesn't change that. Rates doesn't change that. Sort of nothing changes that. Nothing stops that. So to me, that and the valuations on a lot of those industrial related type infrastructure, things like the PAVE ETF, PAVE, the Grid ETF, GRID, excuse me, I don't have any relationship with either of those companies that offer those or anything. But the companies that make up those ETFs, I think are very well positioned. They're not that expensive, and I think they're going to have very strong fundamentals for the next 3 to 5 years at least, if not more. And so in times of uncertainty like this, especially, there's uncertainty, and then there's when is uncertainty priced in, right? So there's uncertainty now, no question. There is no uncertainty priced in. Not very, very little uncertainty priced in. I want to see, is this America's Suez moment on the cover of Time magazine? When I see that, that's when uncertainty will start being priced in.
What is the major geopolitical shift that comes out of of this conflict? Are we expecting a shift in the world order following this, or is this just a continuation of events that have already unfolded?
I think it's more a continuation, and I think it's too early to tell. Um, it just we can see what is happening. There's a battle for material constraints. Um, China has spent trillions subsidizing the build out of Made in China 2025 and its production capacity, and it's, buying up finite commodity stores around the world with dollars. And the Americans have subsidized nonsense wars in the Middle East for 20 years. And so the Chinese thus far have spent their money better. And so in response to this, we are spending more on nonsense wars in the Middle East. So we clearly haven't learned the lesson yet.
I will provide to you, if I may, a piece of certainty, and that is a certainty that the debt is going to go up in the U.S.
Absolutely. I can agree with that.
Congressional Budget Office is now projecting that the interest on the cost alone, the CBO's latest baseline net interest costs are projected to more than double again. It's currently 1 trillion, close to 1 trillion. It's going to go to 2.1 trillion by 2036. I mean, 2036 is the next year, but it's going to double from here. Now, that's just net interest alone. The actual debt level is, currently at 38.8 trillion. It's going to reach 50 trillion, I think, by 2036 as well. But anyway, together they will drive net interest costs up by 121%. What do we do? Not just does this impact the average American who's not an investor, and we'll get to investment implications in just a minute, but does this impact the regular Joe who's not even in markets? How do we feel this?
Absolutely. It raises living costs. It raises inflation, regardless of whatever the government says inflation is. And when the government says inflation's 2 and it's actually 5, that erodes confidence in the government. So number one, inflation's higher. That's not good. Confidence in the government. I saw a survey last month that showed that, in under Ike and JFK and even the early days of LBJ, surveyed Americans' confidence in their government was 80 to 85%. It's now 16 to 19% have faith in the American government. And critically, that's not a Trump thing. That's an Obama, Trump, Biden, Trump reading. It's 16 to 19%. It has hit the floor and there has been no dead cat bounce. It is just flatlining. And as you lose faith in your government, you're going to have continued internal strains, political strains in the U.S. And who knows from there? But ultimately, elevated inflation, elevated domestic political strains, and continuation of the K-shaped economy. Because ultimately, we go back to the earlier point, they're not going to let the Treasury market dysfunction. They're not going to let interest rates rise to a level that force, whether it's Trump or a Democratic or any administration, be forced to cut entitlements and defense in order to pay the interest, right? At the end of the day, right now, as we sit here today, we're spending 70% of near record receipts on entitlements. We're spending another 30% of near record receipts on interest on a gross basis. And we're spending another 25, 30% on defense. And that's going to go up in a war. And so we're spending somewhere between 120 and 130% of record receipts just on entitlements, interest, and defense. That doesn't include national parks, education, labor, roads, all the other thing the American government does. And are we going to, if rates rise to 6, are we going to say, well, we're up $400-500 billion in interest pro forma, guys. We need to cut $400-500 billion out of defense. That's not going to happen. And entitlements can't be cut politically. So I just think it's an emerging market problem in the reserve currency issuer in the world, which means it will also be referred out to the entire world. More inflation, less interest in bonds, and it's a tough situation.
What do you really not like? You really like gold. You talked about some things. You don't like bonds. What else do you really not like coming out of the situation, asset-wise?
I think relative to expectations, long bonds. Like, why? If you call up a chart of, look at, ZB, the U.S. long bond, divided by gold, from the first Iraq War, from the Ukraine War. You know, bonds have collapsed in these wars against gold. They've been terrible. They've been certificates of confiscation, and it's the only way we can make the math work. And so, if we're going to do this, we apparently are. Consensus thinks it's short. I have a very, very high conviction. That's something else I really don't like. If I could short the conviction that this is going to be short, I would short it all day long. And how do I express that? Best way to express that is short long bonds against gold.
How do you feel about U.S. manufacturing? Are we seeing
I
evidence
love
of manufacturing being reshored? Yeah.
Yeah, I love it. And we're seeing a cyclical uptick there. When you see, Chicago PMI, when you see, flatbed rejection rates, right, which is kind of a technical term. Craig, I can't think of his last name. I apologize, Craig, but he does really good work on that on X. He's a consultant in that business, but having covered, things like Landstar, companies like Landstar, in a former life, I understand what that is, which is a flatbed rejection rate is there's so much freight that the guys with a truck are rejecting tenders. In other words, they're busy. And so you're seeing spiking rejection rates. It means you're seeing a cyclical pickup. Now, you always see a cyclical pickup this time of year, typically for things like flatbeds, because it's construction season picking up, etc. But it looks really strong. And we are trying to reshore. And of course, war is very good for manufacturing, as offensive as that may be morally. From an economic standpoint, that tends to be the case. So, manufacturing's in very good shape. I like manufacturing a lot, and that's especially electrical equipment manufacturing, like we were talking about before.
Okay, look, excellent. Thank you very much for your updates. This is what we needed today. What can we follow you?
You can find me at our website, fftt-llc.com, for more information about both institutional and mass market products, and on X at Luke Gromen, LUKEGROMEN.
And you have a book behind you, Mr. X Interviews.
I do, right there.
Mr. X is a fictitious person, so we can tell us a little bit about that book and what we can expect to find there.
Sure. Yeah, I wrote the two versions of it. Mr. Interviews with Mr. X, or Mr. X Interviews Volumes 1 and 2. They are a fictional sovereign creditor of the United States. The books are written in a Socratic method, so question and answer with me and him. And I would say they are influenced by real people I've interacted with, which makes it fun. But the gist of it is trying to talk through in a more narrative way the different pressures and puts and takes around different actions by the various players at the table: U.S., China, Russia, major oil players, Europe, etc.
Okay, good. We'll put the link down below as well. Check out that book. Check out Luke's work. Thank you so much, Luke.
Thanks for having me on.
Thanks for watching. Don't forget to like and subscribe, and don't forget to use my code LIN, LIN, when you sign up to Kalshi. New users will get $10 when you trade $10.